All right, so now we are going to be talking about chapter 10 to see what happens when we collect money, okay, through receivables, okay? So the chapter 9 was talking about how we operate our business, whether we collect money or some kind of form of money, right? And what we do with that money, right? And how do we spend it? Well, in this section here, we're going to be looking at another increment, which is going to be when we allow our customers to owe us on an account and what are the processes of collecting the debt. Because in this case, after figuring out why it'd be better to just have someone else to do it, okay, you'll understand why it is much more difficult for us to collect the debt ourselves when we can pay someone else to do it. Okay? So, receivables. What are receivables? Well, receivables allow us to sell our products to our customers and allow our customers to give us or to pay us later, okay? Or pay us on an account. Now, that is only if you think that your business is able to handle allowing and being able to trust your customers to make sure that they pay you back on time. So this is where we create accounts receivables to in essence to say, hey customer, I'll give you the product now, but you owe me in the future, and I shall send you a bill and I shall be collecting money from you in the future. Okay? So what happens when we come to a cross where those customers won't pay or something happened to them and they cannot pay? Well, that's where we introduce the allowance for doubtful accounts. Because, right, if a customer pays, and that's already straightforward, right? We get the money and we can go on with our lives. But this is what happens when we have those customers that, for any reason that they fall under and they cannot make a payment. What do we do with them? Okay, and this is where we're gonna be introducing you to the allowance for doubtful accounts. Now, there are many ways that you can refer to the allowance for doubtful accounts. It could be doubtful accounts. It could just be bad debt. There's many ways that you can refer to this, but for the sake of this class, I'm going to use the allowance for doubtful accounts, okay? And the allowance for doubtful accounts stems from when customers cannot pay for what they owe. All right? And what we call this is a contra account. It's going to stem from the accounts receivable account because, again, if a customer cannot pay, what do we do with them? Well, we got to separate them and put them into a contra account that helps you reduce the accounts receivable. Okay, so for instances, for anybody that files for bankruptcy and then all the bills are dropped, or if they just don't have enough money to pay for this month, or for reasons where they just refuse to pay. All right, there are some people who just refuses to pay. Okay, so then these kind of customers, why we use the allowance for doubtful accounts is, well, there is a criteria, right? When a customer refuses to pay or they just cannot pay for the month, how do we record it in our records? Well, we know exactly who, because again, if we're issuing out statements or issuing out monthly bills or whatever it is that we are doing, right? Because we're using some kind of accounting system to keep track of our customers, right? We know exactly who missed their payment and who hasn't paid yet, right? We have it in our track record. So at least we know exactly who. And we know exactly how much they owe me, right? Oh, this person owes me $100. They missed their payment. So what do I do now? Now I know exactly who and I know exactly how much, and I know exactly when. Because if you bill them and saying pay me by June 30th, right now it's July 8th, right, or July 7th, you know exactly when they didn't make the payment. So in this case, these are the key factors that you're going to be looking for so you can identify to use the allowance for doubtful accounts, because now you need to acknowledge that this person we need to move their amount of the that they owe us into a contra account to separate them because they are potential debt. So that's what we have to understand. The allowance for doubtful accounts is an assumption that this person, they missed their payment, so that means it is a potential threat to our business because they may not pay, right? So, for instance, for this example here, on December 16, Mr. Sanchez buys a total of $100 worth of toys on an account, okay, and he pays $20 every month. So that's the agreement that they signed up was is they have a payment plan. He's going to pay us $20 every single month starting January. Okay, so first we need to recognize this. We need to recognize that we sold to Mr. Sanchez on an account for that $100 and he's going to slowly pay us back. Okay? So how do we do that? Well, we understand that it's accounts receivable, right? Because we acknowledge that he's paying on an account. And we're going to introduce sales because, right, that's what we sold to him, right? In this case, no sales tax, just to clarify, okay? So in this case, there you go. We make a record that on December, he decides to buy $100 worth of toys. So then the next day, right, so the next month, January, right, January 16, Mr. Sanchez pays us $20 with a check. So in this case, we received a check. So that's going to go directly to our checking account. And we are going to reduce the amount that he owes me because he made a payment. So we're going to reduce the accounts receivable by $20. So now, if you're keeping up with the math, he now currently owes me $80. Okay? Then on February 16, he pays me another $20. Okay, so I record the same thing, checking, and we're going to reduce his account by another $20. Okay, so now, as of right now, as of February, after this payment here, he still owes me $60, right? He paid me $20 in February, paid me $20 in January. So that's $40 taken off of his $100 balance. Okay? So then, all of a sudden, on March 20th, right? So he missed his payment on March 16th. We notice that, okay, something's up. We call him up, and the first thing we find out that he filed for bankruptcy. So that means he can no longer make a payment. Okay? So that means he can't pay. So what do we do with his account? Well, we know for a fact that he owes me $60, right? So therefore, we need to move him out of the accounts receivable because we need to put him into the contra account for the allowance for doubtful accounts because he is potentially at risk to not pay me ever again. Now, when you put a person, or in this case, their account balance, into an allowance for doubtful accounts, what you're essentially doing is you're freezing their account, right? You're removing them from the active customers, and you're actively moving his account into a contra account to basically freeze his account because he can no longer make purchases, nor can he be able to make payments, right? So we're freezing his account in this case. Now, but because we put him in the allowance for doubtful accounts, what we also know is that means Mr. Sanchez still has the capability to continue paying us, right? We're not writing him off forever, right? We're giving him a few extra months as a way for him to, try our hardest to collect the money from him, right? Meaning we're going to be sending more statements. We're going to be calling him saying, hey, what's going on? Is it okay? Are you able to make the payment now, right? We're going to try our best to collect the money, okay? So then, fast forward after that, right? Once we establish that we still have the possibilities to make a payment, right? Then we'll figure out is he able to do it? And if it's not, then we just leave him in the allowance for doubtful accounts till we wait till the very end of the year. Okay? So in this case, that's what you have to understand for allowance for doubtful accounts. Okay? Any questions here? Okay? Yes.
So the timing of us moving out of account receivable to allowance for doubtful account is actually up to us, the business owner. Like there's no regulation or anything that we have to move it. We move it when we decided to move it with the information given to us.
Yes and no. As soon as you find out this person cannot make a payment, you should move it that day you find out.
Oh, okay.
So in this case, right, March 20th, right, which
Yeah.
is past the date because he was supposed to pay on the 16th, right? This is
Yeah.
past the date. So we called him up and said, hey, what's going on? Why are you missing your payment? Okay? And they said, sorry, I filed for bankruptcy, so I cannot make a payment this month. It's already March 20th when we addressed it, right? 4 days later after the due date happened. So in this case, right, that's why when we find out that he can no longer pay but still has a potential to pay, that's when we go ahead and decide to move him from the accounts receivable to the allowance for doubtful accounts. So usually it's typically the day that you find out that that person cannot make a payment.
So as soon as we find out that he's no longer paying us, we're gonna move it. Okay.
Because in this case, right,
Yeah.
if we just let it linger into the accounts receivable, that means we are subject to be pending on him when we already know he might not pay. So at least this kind of gives us a guidance saying, okay, we need to freeze his account because he has a potential to not pay us, and he can't go and buy any more stuff from us.
Oh, so that's also tells us if he asks us to sell him more something, we know we shouldn't be selling anything.
No, we shouldn't. We should be freezing his account.
Okay. Thank you.
Any other questions? All right. So then let's talk about the difference between the allowance for doubtful accounts and the bad debt expense, okay? Because this one is also in regards to when a customer doesn't pay us, but here's the difference. We, as a company, have to adjust our earnings at the end of the year, right? Because what do we do at the end of the year? We have to file for our taxes. And if we cannot claim these people who did not make a payment, what can we do? We can permanently write them off our books completely, okay? Now, here's the rule here. The IRS allows up to only 5% of those bad debt that are uncollectible out of all of your accounts receivable, all right, to be written off without any penalties, right? So we could take a 5% loss because realistically, think about it. If you let everybody in the whole world owe you money, right? What is the chances that someone is actually going to be super 100% responsible and pay for what they owe? We have people who have situations where they're in a financial crunch that they can't afford to pay for it. Okay? So because of that reason, right? They lost their job. They won't be able to get a job for the next 6 months. We can't not rely on them to give us our money if they're currently in a they don't have a job. They can't pay if they don't have a job. So we cannot rely on waiting on them to get a job for them to finally pay us back. So that is why we can choose to write them off our books completely. Okay? Now that means, again, on a company's perspective, right? We can't allow them to open up another account. We cannot do any of that. They have to only let them pay for whatever they buy with cash, right? They can't owe us anymore because of that reason. Now, on our books, how do we write those off? Well, in this case, because the government, the IRS, allows us to take only up to 5%, right? So that's going to be a guesstimated amount, right? Because 5% of my accounts receivable could be anybody. It doesn't have to be particularly Robert or particularly a specific person. That person can contribute. Yes, they can. But this 5% is an overall estimated amount. So in this case, you don't really know who, right? So once again, if I had the whole class, right, owe me money, right? How do I know? Tomorrow, Ibrahim might fault on his payment to me. I don't know. So that also puts in the factor here that because I don't know, and because especially he might be the one responsible to pay, but what if Marcy doesn't pay? I don't know who is going to fault on their payment in the future. And I don't know when, and I don't know how much because every individual that owes me money could have their own separate account balances, right? You can owe me $20, he can owe me 50, and then Marcy can owe me 100. We don't know how much. So these are the three common factors of why you would use the bad debt expense at the end of the year to clear off the debt. Okay? So that's why there's a huge difference between bad debt expense and the allowance for doubtful accounts. Allowance for doubtful accounts is you're doing that throughout the year because you're keeping track of that person, right? But at the end of the year, the government lets you write off 5%. So that means even if Marcy is responsible and pays her amount that she owes me on time, that means I can write 5% off of someone else, right? Okay, so in this case, right, so this is what the difference is. You're getting an estimated amount. You don't know who, you don't know when, and you don't know how much. All you know is you can write up to 5%, which means you're creating an estimated amount. Okay, so again, that estimated amount can include the people that you for surely know contribute to that bad debt, and also a portion of it could be people that you are not sure, right? Because I don't know, Marcy can lose her job at any given moment in time and be like, and call me up and say, I can't pay. That is a random, unexpected, unfortunate event that will affect the her status into paying me, right? So this case, that's why you would use the bad debt expense. Okay. Now, again, bad debt expense is an adjustment entry because you do not do this on the daily. Okay? You only do this towards the end of the year. Okay? Usually. All right? It's an adjustment that happens at the end of the year. Now, if you're a corporation, you guys have freedom to write off every month if you'd like, because the amount of money that you are letting people borrow compared to the people who are actually paying to the unfortunate of people like having financial circumstances that causes them to not be able to pay is a lot higher than it is for a small mom and pop shop, right, who only has 100 customers. So in this case, right, it's usually done at the end of the accounting period. Maybe I should say that instead. Accounting period, depending on what you establish yourself as, right? It's an adjustment that happens at the end, okay? This never happens during the actual year. Unless stated otherwise, unless your accounting period is at the end of every month, okay? So again, that's what you need to know, and here's the difference on when you are using the bad debt expense account, okay? There are two methods for you to record this bad debt. The first one is the direct write-off method, and the second one is the allowance method, okay? The direct write-off method is for tax purposes only. That means the IRS and only tax accountants are able to do this. Now, in this case, right, let's review. Are we the tax accountant or are we just the bookkeeper or the accountant in general? you have to go to school for to be a tax accountant. So in this case, we are not the tax accountant because we're just a simple bookkeeper or the simple general accountant. We cannot follow the direct write-off method because we are not going to be the ones that are going to be filing for taxes, right? The tax accountant's going to help us file the taxes for us. So in this case, we are not going to be learning the direct write-off method. This one literally takes the amount that bad debt, right, and takes it directly off of the accounts receivable. You see this? So in this case, this is the example here. You would use bad debt and write it off directly from your accounts receivable. We cannot do that, okay? However, we can do the allowance method. This is governed by Acct, right? That allows general accountants, bookkeepers, in this case, it's just general accountants, to be able to write off bad debt using the allowance method. Okay? And there are two ways on top of that to write off the bad debt using the allowance method. Okay? So let's go ahead and explore what those options are. Okay? So in order to properly write off the bad debt, let's go ahead and look at the first one, which is using the balance sheet method. Okay? So for instance, this example here says that it is estimated that $25,000 out of a $500,000 accounts receivable is to be uncollectible. Okay, so that's 5%. Now, there's currently a debit balance of $5,000 in the allowance for doubtful accounts. Okay, how do we know that? Well, if we're doing the allowance method or the allowance for doubtful accounts during the year, you create either a debit or credit balance. Right? You create the debit or credit balance. So remember, right? For example, that the example that we saw earlier where Sanchez, right, told us that he can't pay. So what did we do? We took the $60 amount from the account receivable and put it into the allowance for doubtful accounts. So now my allowance for doubtful accounts has a debit balance of $60, right? Because we just debited. Now in this case, so that number, this debit of $5,000 comes from calculating all of the accounts receivable during the year. Okay, so now that we reach the end of the year, it is now saying that now we actually have an account balance of $5,000 in the allowance for doubtful accounts. Okay, so how do we journalize this? So in order to journalize the bad debt expense, we're going to put in bad debt expense because it's an expense, right? And we're going to take it out from my allowance for doubtful accounts. Okay, so here is the rule. Because we're using the balance sheet method, how do I calculate how much to write off? The rules are you're going to need to identify, number one, the estimated amount. So in this case, it is estimated that $25,000. So $25,000 is your estimate. Okay? Next thing you're going to identify is what account are you taking it out from? I'm taking it out from my accounts receivable. Okay? Accounts receivable is going to trigger you to go to this method, which means then you have to complete a third step was, is there an account balance in the allowance for doubtful accounts? And if there is, you need to, if it's a debit, you need to add. If it's a credit, you need to subtract. Okay? Now, why is that? Well, first off, right, your end goal here is that this estimated amount of $25,000, right? Because this is bad debt, that means we need to end in our allowance for doubtful accounts with $25,000 credit. Okay? If there's a balance of a debit balance, right? If we're on the left side, we need to be on the right side, 25,000. So you need to backtrack that 5,000 and then end up on the credit side for 25,000. Okay? So that means you need to add those two numbers together. Now, if you're already on the if you're already on the right side, so you already have a credit balance, you need to add up to get to the total of 25,000, okay? Because at the end of the day, $25,000 is your end goal. Okay? So that's just that right there. Okay? So why do we refer this to the balance sheet method? Well, let's take a look on the balance sheet. What happens when you complete your balance sheet? You're listing out all of your assets. Accounts receivable is an asset. Allowance for doubtful accounts is a contra asset account. It appears on the balance sheet. So therefore, that is why we must use this method when we identify the word accounts receivable. Okay? And that will tell us here. So if there currently is a debit balance in my allowance for doubtful accounts, so right now I'm on the left side, right? How much do I need to calculate to get 25,000 credit in the allowance for doubtful accounts? Well, if I do the rules here, if I just simply use the rules, $25,000 is my estimate. Accounts receivable is the keyword I'm looking for. There's currently a debit balance of $5,000. So that means I'm going to take this $5,000 and I'm going to add it to my estimated amount. And that's going to give me my grand total of $30,000 I need to put in my bad debt expense and put into my allowance for doubtful accounts, because my allowance for doubtful accounts needs to be at the end $25,000 on the credit side. Okay? Any questions there? Yes.
The estimation of $25,000, in this case, it's given to us, or are we following that 5% rule we were talking about?
In this case, I gave you the number.
Okay.
But for any reference points, so again, let's say for Coffee Cafe, I won't give you it, so you have to figure it out by taking the rules of IRS, the allowance of 5 up to 5%. So we have to figure out what that estimated number is. But in this case, I gave it to you.
Okay.
Any other questions? Okay. So then, scenario 2. What happens if I actually have a credit balance of $5,000 instead? Right? Same scenario, but this time I have a credit balance of $5,000. So I'm already on the right side, 5,000, right? How much more do I need to get to equal $25,000 on the credit side? In this case, right, when we use the rules here, we identify that there's a credit balance, so that means we need to subtract. Okay, so therefore, you're going to take your estimated amount, 25,000, and you're going to subtract the balance of 5,000 to get you $20,000. Okay? Right? So that was the balance sheet method. Okay? Now let's take a look at how to utilize the income statement method. Okay? The income statement method, excuse me, we have the same exact scenario, okay, where we are estimated that you have $25,000 of a $500,000 total credit sales, okay, which is to be uncollectible. All right, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts. The rules here say you need to look for only 2 things, not 3. Only 2 things. You need to identify what the estimated amount is, and you need to identify the keyword total credit sales. Once you establish that, then your number is just going to be your estimated number, which is going to be 25,000. Right? Now, wait. Why for the income statement we're only looking for one number? Well, let's take a look on my income statement. My income statement is going to show me all my profits, or in this case, my income and my expenses. In this case, does it show me anywhere for my accounts receivable and my allowance for doubtful accounts? In this case, no. All we see is my cash sales and my credit sales, right? Credit sales meaning sales that you've collected on an account. It doesn't tell you specifically those are accounts receivable. Okay? So in this case, that's why for this one, we don't care about the allowance for doubtful accounts because it doesn't affect the allowance for doubtful accounts, right? It only is affecting my total credit sales. So that is exactly why when we identify this problem, we need to look for only two things, the estimated amount and the total credit sales. So in this case, my estimated amount is $25,000. I do identify total credit sales, so that's going to give me my estimated amount of $25,000. Okay? All right? Even if I try to trick you and say, well, there's a credit balance this time for $5,000. We see the word credit, right? No. You still identify the same two things. What's my estimated amount? Do I have the keyword total credit sales? In this case, I do. So the allowance for doubtful accounts does not matter to me. Okay? I'm still going to identify that is $25,000. Okay? Now, out of those two methods, as you can see, the total credit sales is obviously much more easier. You only need to choose one or the other. You cannot do both, okay? Because they're both dealing with bad debt. Now, they just recommend you that you can use either way. They're both completely correct. Just like for inventory, right? You have the indirect method and the direct method. It doesn't matter which one you use as long as you use only one out of the two. Okay? Because they're both correct ways to journalize this properly and they're both governed by GAAP. It's not, they're both correct. None of them are wrong. It's just whether of a preference. Do you prefer to use the balance sheet method or do you prefer to use income statement method? Okay? Any questions about section 10.1 at all? Because that is it. Yes.
So for the income statement method, we pay attention to the total credit sale, which we know is $500,000, correct?
That is the total credit sales, yes. But we are focusing on just the estimated amount
of the total credit sale.
Correct.
Okay. Gotcha.
Any other questions?
Thank you.
Okay. So let's go quickly over the chapter review. So we identified what happens when we allow people to borrow money from us, or not borrow money, excuse me, owe us money for products and services that we sold to them. This is what happens. You place them on an account. If they choose to fail to pay us, we got to identify that. We got to put them in an allowance for doubtful accounts. Okay? And then there are two things that we need to record, right? At the end of the year, we will be recording the bad debt. But during the year, we'll be using the allowance for doubtful accounts. Okay? Now, when we reach the end of the year where we need to write off the amount of bad debt because IRS allows us to write off 5% without any penalties, right? They allow us to take up to a 5% loss. Then there are two methods beyond that, okay? First method is direct write-off method, which is for tax purposes only, which you need to know so you can identify, right? That you cannot do this. So you need to know that that's for tax purposes only, the direct write-off method. You cannot do. However, you can do the allowance method, right? The allowance method is governed by GAAP, and it's meant for all accountants to be able to do, okay, at the end of the accounting period. That allowance method breaks into two more methods, right? We either choose the balance sheet method or the income statement method, which for the balance method, right, three things that we need to identify, right? We need to identify the estimate, the word accounts receivable, and the account balance in the allowance for doubtful accounts. So if it's a debit, we add. If it's a credit, we subtract. Where the income statement method only has us identify two things, the estimated amount and the keyword total credit sales. But from those two methods that we choose from, one of them, right, you're still going to journalize it exactly the way it should be, right? Bad debt and allowance for doubtful accounts. This does not change based on the method that you use, okay? Just like when we make purchases of inventory, right? And then we adjust our inventory, it doesn't matter what costing method you use, right? The journal is still going to look the same. The only difference is how you calculate it and what the number is going to be debited or credited. That's the same thing here. Okay? All right. So that was chapter 10.1. So let's go ahead and go over the exercise and then we can call it a weekend, okay? So chapter 10.1 exercise here. Let me make this a little smaller here. Okay, so question number 1. On December 15, Robert buys a total of 100 coffee mugs at $9.99 each on an account. Sales tax is 8.25%. So here's an example of what we do with sales tax. Okay, so in this case, how are we going to journalize this transaction?
We put it in account receivable, and we have sale and the sales tax payable.
Good. So we got accounts receivable, we got sales, and then we have to charge the tax on here.
So the credit for sales tax payable is 82.42.
Let's do sales first. How much is my total sales?
$999.
$999 and $900.
99
Yes.
dollars and 0 cents.
It's 0 cents. Yes. Sorry.
Okay.
Okay. And then the tax on top of that is going to be $82
and
42 cents. So that means in grand total, how much is Robert going to be owing me?
$1,082.42.
$1,082. No. It'd be $1,081.
Yeah, $81.
And
I had it right, then I got myself.
no worries. Okay, so in this case, it's up to you. You could say we sold 100 mugs. Okay. You don't have to specify to Robert. Okay. All right. So then on January 15, Robert sends a check for $25. So maybe his agreement is that he's going to make monthly payments. So he decided to say he sent us a check for $25 on January 15. So
checking for $25 debit, and then accounts receivable for 25.
yes, so in this case, he's paying a portion for what he owes. So therefore, we need to reduce what he owes by $25. Okay. All right, and then of course you could say received payment from Robert. Okay. So then on February 15, Robert informs us that he can no longer pay due to his financial circumstances. So we find out February 15, he can't pay anymore.
So we moved the account receivable
Mm-hmm.
of $10,056.42
To where?
allowance for doubtful account.
Good. Allowance. Good. For doubtful accounts, right? And we're moving that out from our accounts receivable. Okay? For how did you get that $1,056?
Yeah, I get 1,059.
Okay, let's see. If he owes me right now 1081.42.
No, got it wrong. Sorry.
Okay, all right. Okay. 1081 minus $25. He owes me 1056. Okay, so 1056.42. No worries. Okay. So he owes me 1056.42 because why? Well, he owed me in December 1081, right? But he made a payment to me which reduced the amount that he owed by $25. So right now his current balance is 1056.42. So because he decided to say I can no longer pay, we need to freeze his account and move for what total amount that he owes me for. Right? So which is that 1056, and I'm going to go ahead and say to remove Robert from AR balance, or to remove Robert's AR balance. Okay. Number 4. Okay. Then on June 15, Robert says he can pay another $25 for this month and sends a check. So in this case, right, because in February he had some financial burden, so he called us saying I cannot pay this month, right? So that means okay, that's fine. We'll give you some time. We'll give you, what is it? We'll delay your account, or we'll freeze your account temporarily until you can make the next payment. So then June 15, he decides to make a payment. So how do we go about this?
We use checking because he's paying us a check or
Oh,
cash.
okay. Okay. He's paying us with a check, okay?
And then he's also reducing our allowance for doubtful accounts balance.
Okay, so in this case, no.
No, okay.
His account's frozen.
But we're not taking $25 from the balance, total balance of the allowance for doubtful account.
Okay? Yes.
I credit $25.
Okay, but my question is right now, his account's frozen.
So you wouldn't put anything. You can't take any money because he doesn't have an account to take money from.
Okay, so what do we need to do in order to take that money?
You'd have to bill it, and whenever his account's unfrozen, it'll credit it.
Okay. You stemmed a little far from there, but you're right. We can't accept it because he has no account. So what do we have to do? Because right now his account's frozen, right? What do we have to do?
Transaction.
Well, we still have to
Pending.
we still have to record it because he's paying for what he owes. Okay. So if you froze an account, how do I make the account active again?
We have to unfreeze.
We have to unfreeze the account. So in this case, we need to unfreeze him. How do you unfreeze account?
By putting the allowance for doubtful account back to account receivable.
Excellent, right? Because then we are able to take the money out from accounts receivable, exactly like we said, right? We can't do it because he has no account balance with us, right? So you need to undo the transaction in order for him to have an account balance for us to receive the payment. So we have to revert that. We're gonna add the money back into the to the accounts receivable, right, from the allowance for doubtful accounts, right? So this is where oftentimes, there you go, there's the credit in the allowance for doubtful accounts balance. You see where the credits come from now? Because we have potential people that end up paying for what they owe later on in the future. So this is
Oh, you're talking
why
about paying for credit card bill.
no. This is him paying for what he owes me. So in this case, because this is where the credit comes from, right? Remember, why did we create a credit balance in the allowance for doubtful accounts? It's because, look at this, I'm crediting the account now. That's where the credit balance comes from. Okay, it doesn't just show up from anywhere. Okay, we generate the debit balance. So right here in the very beginning, we created a debit balance in my allowance for doubtful accounts, because right now that credit balance is for $1,056, right?
Right.
But because we're crediting it now, right now it's going to be zero. But at the end of the day, if Robert's not my only customer, so
Right.
maybe someone else is also going to pay for what they owe. So that's going to create my credit balance in my allowance for doubtful accounts. Okay?
Okay.
So that's where this generates from. So that's what I'm trying to tell you guys. So like where these debits and credit balances come from when we have that balance in our allowance for doubtful accounts. It comes from doing the transactions during the accounting period. So in this case, we're gonna undo his account. So we're gonna put back that 1056.42. Okay. So now that we undid that, right, we unfroze his account, right? So then I'm gonna go ahead and say to move Robert's accounts receivable balance. Okay. So then now that we've done that, we can now actually collect the payment that he made. So again, we are going to be receiving our checking account, right? Because he wrote us a check, and it's going to reduce his account because he now actually has a balance to be taken out from. Okay. So how much was that? It was for $25. Okay. Yes.
So when we putting the unfrozen his account,
Mm-hmm.
we it's always either we put the whole balance back. We never do a partial balance unfrozen.
In this case, right? It's like in real life, right? If you
Yeah.
freeze an account, that means you can't do anything, right? But
Yeah.
if you unfreeze account, you can't just expect, oh, he's only gonna pay me this much, right? Because now that you unfroze his account, that means from here on forth, Robert can make a payment, right?
Oh, gotcha.
Right?
So our hope is up again. That he
Yes,
might able
yes,
to.
correct. Our hope is up again where, oh, wait, finally he's making a payment. That means he has a possibility to make another payment. So we shouldn't put his count on hold anymore because he's active again.
Okay.
Mm-hmm. Now
So
then,
that we assume to use the allowance for doubtful accounts. And then we assume because that way we don't know for sure. We don't use bad debt until we know for sure it's not coming back in.
absolute, that's correct.
Okay.
Okay, so receive payment from Robert. Okay, for $25. All right, question 5 here. On July 15, Robert files for bankruptcy, and the bank collector informs you that he can no longer make any payments. So, or the sorry, he can no longer be collected. I'm sorry, the bill can no longer be collected. So that means we for surely know he's not going to ever pay us back because he already filed for bankruptcy. So that means that wipes every credit, most credits, I guess, from what you owe. So in this case, we have to wipe it off of our system too. Okay? So what do we need to do here? It's July 15.
Do we debit bad debt at this point?
Okay, so when do we do bad debt?
At the end of the year, right?
Correct.
So we debit allowance for doubtful accounts for the 1031 because he made the payment.
Because he
And
can
then
no
we
longer.
credit accounts receivable.
Correct. We got to put it back and freeze his account again, just because we haven't reached the end of our counting period yet. We can't write it off at the end right now because we're not filing our taxes yet.
Okay.
So in this case, that's absolutely correct. So in this case, whatever 1056 minus another $25 will leave us 1031. Good, right? All right, and then again, I'm going to also make another statement says to move, or I guess I'm going to say to remove Robert's accounts receivable balance. Yes.
So at this point, we have now been told for sure this is a no one. Are we going to make note of that in that comment there so that we know at tax time that he's not coming back ever?
Yes, you can, but when we dive into the actual class project here, you will actually have a whole designated section for just your customers. So you can make that note, you can flag it, you can make it red, so then you know this person can never come back to your store again, or if they try to come back to your store, you can flag them down. Yes.
Okay.
Yes.
All right.
You don't necessarily have to put it in the notes in the journal. You will have a designated section to put that in the actual customers list when you have it. Okay? Yes. And then if you use Excel for that, you can even highlight them red to let you know this is a red flag. Okay? All right, number 6. Now it's December 31st, and your company estimates that $2,590.54 of its total $29,475.72 accounts receivables are to be uncollectible, including Robert's debt. Okay? And of course, you have a total credit balance of $157.62 in the allowance for doubtful accounts. Okay? Because remember, Robert is not your only customer. Okay? So in this case, right, it's December 31st, and how would I go about journalizing this transaction here?
Do we know which method that we're gonna use?
What are the key words to tell you that?
Well, the 2,500 is just an estimate where
The total credit balance that we know.
Is it total credit?
We have a total credit balance of 157.62
In what account?
in allowance for doubtful account.
Okay. What was the key word to help you identify which method to use?
Account receivable.
Yes, accounts receivable is the key word, right? That should automatically tell you, oh, you're using the balance sheet method. So if you're using the balance sheet method, does the allowance for a doubtful account balance affect your answer?
No.
Yes.
Oh yes, because
Yes.
we have to add or subtract the number.
Yes. So that means we do care about what the balance is in the allowance for doubtful accounts because we have that keyword accounts receivable, right? Because on the balance sheet, right, You list out all of your assets, and the accounts receivable is an asset. So is allowance for doubtful accounts. It's a contra asset account. Where on the income statement, none of it appears on there. We don't care about accounts receivable, and then we don't even care about the allowance for doubtful accounts. We only care about total credit sales. Okay? So in this case, this does tell you that you're using the balance sheet method. So if you currently have a credit balance, what are you going to do with that $156.62? $57.
From the 29,000 accounts receivable we subtracted, right?
Not 29,000.
From the estimate?
Mhm. Mhm. You need to, for the balance sheet method, you need to identify three things. Number one, what is the estimate? In this case, the estimated amount is the $2,590.54. Okay? We don't care about the overall. We care about what is estimated. Second thing is we need to look for that keyword, accounts receivable. Okay? In this case, we have that. So that means our third step is we need to identify what the account balance is. We have a credit balance. So that's going to tell us that we need to subtract. So in this case, what is $2,590.54 minus that $157.62?
$2,432.92.
Okay, I'm going to take your word for it. Okay, so 243292. Okay? And
Check.
okay, so in this case, okay, so what accounts am I going to be using now that I am at the end of my accounting period? What account am I using?
We have bad debit expense
Yep, bad debt expense.
and for debit, and then we have allowance for doubtful account for credit.
Yes, we are going to take this out from our allowance for doubtful accounts. Okay. All right, and that is to write off the whatever percentage that is. In this case, this is over 5%, but that's okay. Then we just have to pay for that penalty. Right? All right. So for the following problems here, they are not related to the problems from 1 through 6. So number 7, if a company estimates that 20,000 of its 500,000 accounts receivable are to be uncollectible, there is currently a debit balance in the allowance for doubtful accounts for $5,000. The adjustment entry will be
So that would be bad debt expense for 2,500 or 25,000, right?
so good because here the estimate is 20,000. We have the keyword accounts receivable, and there currently is a debit balance. That's going to tell you to add that $5,000 to the 20,000. So yes, that is correct. You have $25,000 in your journal here, and it's for the bad debt expense. And you're going to take it out of your allowance or doubtful accounts. Okay, save some time here. All right. Question number 8. If a company estimates that $20,000 of a 500,000 total credit sales is to be uncollectible, and there's currently a credit balance of $5,000 in the allowance for doubtful accounts, the adjustment entry will be
Not in the income statement method. So
okay. So how much am I going to debit to the bad debt expense?
$25,000.
Not 25.
No,
50,000.
20,000, because in this case you just identified correct that this is the income statement method. So if it's on the income statement method, right, the allowance for doubtful accounts and the accounts receivable don't even show up on the income statement. So you don't even care about what a balance there is. All you care about is what the estimated amount is. So in this case, the estimated amount was just $20,000. Next question here. A company estimates that 20,000 of a 500,000 total credit sales is to be uncollectible, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be
Again, $20,000.
yes. So again, trick question here once again. It doesn't matter whether there's a debit or a credit balance in the allowance for doubtful accounts. You choose to ignore it because we're using the income statement method. So in this case, it is for $20,000 because you only care for what the estimated amount is. Okay. All right, last question of the day. Oop, come on. Last question of the day. If the company estimates that 20,000 of a 500,000 accounts receivable are to be uncollectible, and there's currently a credit balance of $5,000 in the allowance for doubtful accounts, the adjustment entry will be
$15,000.
yes. So in this case, right, we identified this is the balance sheet method because of the word accounts receivable. So we know that the estimated amount is 20,000. The balance right now is currently a credit balance for $5,000. So you're already on the right side. How much more do I need to get to 20,000? In this case, 20,000 minus the 5,000 will give you 15,000. Right? All right. That is it for today's lesson. All right. Any questions?